Well, by most readings, it's positive in terms of the tier one cities post peak recovering. There will be some challenges along the way, of course, as was true for the world over. But in market terms, it's certainly been positive. Although we see trend growth tactically positive for now, but in terms of speed and breadth, that will be an uneven trend over the year.
So it's an interesting chart. I think that's Beijing, right? That indicates to what extent we expect this trajectory to be pursued in terms of the pandemic and infections.
So the peak in late December, and what supports that is, of course, the mobility numbers based on metro data, which is one of the more accessible points. That's also showing a normalization of some sort. Still early days, but certainly a recovery which is now being reflected into the market.
There's been a lot of chatter about commodities picking up, that the China reopening theme is positive for that end of the market. What are you seeing?
So the commodity story has already been in place, particularly in copper, and that's why it's top in our global cross-asset model, but overbought. There was a little bit of also buy.
So we've already seen the best of the gain.
For now.
Yes.
Yes. Oil further upside surprise potentially above $85 on West Texas with a potential plus $10 technically, but also particularly if China growth story expands stronger. And then of course there are some currency commodity plays like Aussie dollar, Brazil in terms of its copper proxy, and then maybe the China yuan in general, just in terms of the outperformance it's already had. Plus 10% from November last year.
If I can just pluck out the information that we had from the weekend, that the Chinese tourist was on the move, at least domestically anyway, were off to see family and friends, going to see things they hadn't seen for a while, really enjoying the freedoms that they've not had for a number of years. And they were spending that money like we kind of did around services and around travel, not necessarily on devices. What does that mean in terms of the technicals and the things that you're looking at?
Well, technically, the markets have already been pricing it in, and certainly we see that mostly on CSI 300, which is a diversity play on the A shares and the Shenzhen. For that reason, it's probably a better risk proxy, particularly because the global tech play is overdone, also in China. So that's been storming ahead this year, but that's definitely overbought. And likely more at risk for geopolitical tensions in terms of potential US delisting and whatnot.
So CSI versus Shenzhen is the play you see?
So CSI onshore being a better play to maybe overweight, whereas the growth story in terms of offshore stocks likely something that is better to be neutral or underweight on.
The government is obviously keen to try and repeat this narrative around the desire to stimulate domestic demand and to get consumers to spend. But we know the Chinese consumer hasn't had the same support that Western consumers had through the pandemic period. So they've had to spend their own savings on medicine and food and effectively just getting through this the pandemic period. To what extent is that going to complicate the recovery?
Well, certainly part of this uneven recovery story. It's no straight line. I think some sectors like the healthcare and maybe interest rate sensitive sectors will outperform and be good proxies for now. But certainly it's something to watch over time. The markets are strong already, but something we should still continue to play out for the rest of the year.
Yeah.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.